Silver just hit $80. The dollar just reached its highest level since November 2024. And most investors watching both numbers at the same time are asking the wrong question. Silver prices dropped 3.3% to $80.54 per ounce on March 14, 2026, pressured by a strengthening US dollar and shifting expectations around Federal Reserve rate cuts. That is the standard explanation. A stronger dollar makes silver more expensive for foreign buyers. Foreign demand weakens. The paper price falls. Every financial headline today will say exactly that. And technically, that explanation is correct. But John O.G. does not stop at textbook explanations. John O.G. asks the question underneath the textbook explanation. Because the question beneath today's silver dollar move might be the most important macro question in the entire 2026 precious metals market. The dollar index climbed toward 100 this week and is heading for a second straight weekly gain. The driver? Safe haven demand as the Middle East conflict continues escalating. Oil prices surged after Iran's leadership pledged to keep pressure on the Strait of Hormuz, while attacks on regional energy infrastructure intensified inflation fears across global markets. That pushed expectations for the next Federal Reserve rate cut from July to September. So now we have three facts happening at the same time. The dollar is surging because of war, silver is falling because the dollar is surging, and the war driving the dollar higher is also driving the inflation that historically launches precious metal bull markets. All three statements are true, and all three seem to contradict each other. Understanding why that is not actually a contradiction is the key to understanding the silver market right now. This is John O.G. One handle, two platforms. The fingerprint they cannot replicate. This channel has never sold you anything and never will. Subscribe. Drop OG in the comments. Let's go. Let me show you the complete mechanics of what is happening between the dollar and silver right now, because there are three layers to this story, and most mainstream analysis only looks at the first one. Layer 1. The textbook. Inverse correlation. Silver is priced globally in US dollars. When the dollar strengthens, silver becomes more expensive for buyers using other currencies. That tends to reduce demand, and the paper price falls. Historically, a 1% increase in the dollar index correlates with roughly a 1.5% to 2% drop in silver's paper price. This week, the dollar index jumped 1.1%, its biggest single-day gain since May last year. Silver dropped 3.3%. The correlation worked almost perfectly. So at the surface level, the textbook explanation holds. But that is only layer 1. Layer 2, the safe haven paradox. The dollar right now is not rising because the US economy suddenly became strong. GDP was just revised down to 0.7% growth in Q4, half the original estimate. The dollar is rising because global capital is running toward safety during geopolitical instability. When war risk rises, investors rush into US dollars and US treasuries. That pushes the dollar higher, and treasury yields higher at the same time. 10-year yields recently surged toward 4.24%, increasing the opportunity cost of holding metals that do not generate yield. But here is the critical detail most investors miss. The DXY index does not measure the dollar against real purchasing power. It measures the dollar against other currencies like the euro, yen, pound, and Swiss franc. If all currencies are losing value but the dollar is losing value more slowly, the DXY still rises. Which means the dollar can be strengthening relative to other currencies while simultaneously losing real purchasing power. That is why gold and the dollar sometimes rise together. And it is exactly what we are seeing right now. Layer 3, the stagflation breakage. Now we reach the third layer, the one that historically changes everything. Stagflation, the combination of high inflation and slowing economic growth. US PCE inflation has remained above the Federal Reserve's 2% target for 48 consecutive months, 4 straight years. Meanwhile, GDP growth has slowed sharply. That combination, persistent inflation plus weak growth, is the textbook definition of stagflation. And stagflation is the specific environment where the traditional dollar-silver inverse correlation begins to break down. Because during stagflation, metals stop behaving like commodities. They start behaving like monetary insurance. The historical parallel most analysts now reference is 1973 to 1974. Central banks trapped between inflation and recession. Energy shocks disrupting global trade. Policy credibility eroding. That period preceded silver's historic rally from $3 to nearly $50, more than 2,000% upside. Institutional stress tests published in 2026 now explicitly reference that era as a possible macro comparison. And those models warn of something markets had not seen in decades. Triple red episodes, periods where stocks, bonds, and the dollar all moved negatively at the same time. That dynamic returned in 2025 and again in early 2026. which means the financial system is now operating under macro conditions that historically favored hard assets. Now let's talk about the most important institutional interpretation of the current dollar surge. The World Gold Council recently characterized the recent dollar strength as a temporary rebound, not a long-term trend reversal. Their research notes that the broader downtrend in the dollar index is likely to resume once the immediate geopolitical shock stabilizes. Why? Because several structural pressures remain in place. U.S. equities remain historically expensive. The dollar itself is still highly valued compared to long-term averages. And foreign investors are beginning to find alternative markets in Europe and Japan. In other words, the dollar's current strength may be driven more by war-driven capital flows than by economic fundamentals. Historically, these spikes tend to fade once the acute phase of geopolitical crises passes. We saw that after the Suez Crisis, after the Gulf War, and after the 2003 Iraq invasion. Each time the dollar surged temporarily, each time it eventually reversed. Now, zoom back out to silver. Silver is down roughly 10% for March so far, but the broader trend still shows powerful momentum. Silver gained almost 20% in January and more than 10% in February. The recent volatility appears driven largely by positioning in macro headlines rather than a structural shift in supply and demand. Technical analysts now focus on two key levels: the $80 level, which silver is testing right now, and the $90 level, which acts as the next resistance zone. If silver regains momentum above $80 and stabilizes, analysts believe the market could reopen a move toward $96, which marked the early March highs. Now the honest counter-argument: silver historically falls harder than gold during dollar surge events. That is not speculation. It is a structural feature of the market. Silver carries both monetary and industrial demand, which makes it more volatile. During risk-off dollar rallies, silver often drops 2 to 3 times faster than gold. That dynamic is exactly what we saw this week.